So if you've been baffled of the performance of the property market over the last couple of years, be set to be even more baffled as the property market still is on the growth, breaking records in the face of all the odds being stacked against this. We're still getting lots of growth. I'm Harvey, I'm a remote property investor, and this is April's property market update. And in this update, we're going to discuss what's going to happen with the market. Are we going to get a crash? Is it going to continue growing? Now it's growing in the face of all the odds against it, with interest rates rising, with these wars going on. What is going to happen in this property market? So stay tuned, and I'm going to share with you exactly what's been going on over the last month in the property market and try and clear up some of this confusion. Many of you must be thinking, should I buy now? Should I sell now because the market's high? Should I hold on? Should I wait? One of the things for sure is if you smash that like button, you're going to get a better answer on what you should be doing in your property market. But all jokes aside, let's get into this April market update. But look, the reality is nobody can time markets. Time in the market always beats time in the market. Warren Buffett, one of the best investors of our generation and of all time, says this all the time. Nobody can time markets. So make sure you're in the markets for long enough to beat the markets and don't get wiped out like in the '08 crash. So loads of people in the property market got wiped out through over leverage, through a number of reasons. So make sure you stick to the end, because I'm going to share with you, regardless if the market goes up, regardless if the market goes down, what you should be doing and can be doing to beat this market and stay time in the market and stop trying to time the market. For any of you who's a bit impatient, we're going to put some timestamps along the bottom so you can rush to the part you want to rush to. We're going to look at some stuff from Rightmove and some information from Rightmove. We're going to look at some stuff from Zoopla, two of the leading portals for selling properties. Got lots of data, but it's sold data, it's for sale data as opposed to sold data. We'll also look at Nationwide, one of the leading price indexes out there, and some reports. Going to look at a report from Forbes magazine, and also an article which has come from Estate Agents Today that is a really good documenter of the property market. So if you've not checked them out, check them out. And lastly, as I said already, what you should be doing and can be doing as a property investor in this market to navigate this safely without losing your shirt. So let's get into it. Let's start with Rightmove. So Rightmove, the biggest portal in the UK, hold a hell of a lot of data, and Rightmove in their latest market update, they are saying another new price record as the average prices of properties coming to the market jumps by 1.7%. That is £5,760 this month to 354,564, breaking through the 350k barrier for the first time. The average monthly rise is the largest seen at this time of the year since March 2004. The annual rate of increase to 10.4% with all regions and countries except except London and Scotland are now up 10% annually. So again, going into this London thing, I was in a conversation the other day with somebody else saying London still makes a great investment. Check out my my Reels video. It's on TikTok as well, but check out the Reels video where I'm standing in a telephone box and I say people that think they have to invest locally is very much like people that think they have to only use a telephone box to make phone calls. We've got a magical device nowadays called a smartphone that enables us not to have to walk to a phone box anymore and make phone calls. For you, loads of you that can remember that. It also enables us at a click of the fingers to get data on areas and to invest anywhere and to do video calls. It opens this whole playing field up. It's not just my opinion, Savills agrees with this. The Office of National Statistics agrees with this. The reason London's lagging behind is the price per earnings ratio. And as infrastructure and jobs going into the north, we're seeing this really pick up. It's quite exciting to see the country thriving as a whole country again, much like it did in the past when we had steel, coal, infrastructure, trains, steam engines, the revolutionary powerhouse what we was as the UK at them times. Again though, we've got this war looming, and look, if you've not watched my last video on this about signs of a recession, we could hit a recession, but we're in booming times. Although there's loads of signs for a recession, definitely check that video out about we could hit a recession. You can find that link here. But Rightmove, this is what they're saying about what's going to happen to the market. Again, even these people can't predict this. As I said, time in the market beats time in the market. Just a little reminder. So they're saying it's too early to know how the market will be affected by the long-term economic impact of the war in Ukraine. Rightmove initially saw a slight lower buyer demand, but this has now stabilized. We forecast a less frothy market in the second half of the year as economic headwinds lead to more evenly balanced markets, though demand will still outstrip supply. And this is one of the big things that everybody's pointing towards. The supply of homes are not meeting demand of what people need. And it doesn't take an economic whiz kid. Yes, we have got some headwinds with rate rises, cost of living's going up, but if the supply is still lower than the demand that's needed, it's still going to keep on pushing that pressure upwards unless there is some major event. But we don't know what's going to happen with this war. Look, we've got Russia not going to plan for them by all accounts in the media. Might be not in the media, but you never know. We're closer to World War III than we could ever have been since World War II. And if that happens, then who knows what happened to the market. So again, going back to time in the market will always beat time in the market. And I'm really going to stress that. Repetition is the mother of learning, and that's why I keep on going over this in this video. So in an article published on the 4th of March by Zoopla, it states that house price growth shows signs of slowing as supply increases. So their headlines are slightly bit different to some of the other ones. This is why you've got to try and get as much data as possible. And again, it is confusing, as I said, but they're stating their key takeaways is the number of properties put up for sale were 5% higher in January than the 5-year average. House prices rose 7.8% in the year to the end of January, but the rate of house price growth may be easing. The mismatch between supply and demand continues. So again, they factor in supply and demand, even though they're saying it's easing, but everybody's heading towards this could be easing, but there's still a supply and demand issue, which is going to keep on putting the pressure on this. Look, as a nation, we should have been building over 300,000 properties per year, every year, since the 1990s. We're up to around 200,000 properties, but we, all the way up from the 1990s to about 2012, we didn't get above 100,000. And then in the last recent years, we're around 200,000 per year, still 100,000 short of the recommendation of what we should be building. Yet, all that compounded effect of the previous houses we should have been building is still piling up that pressure. So this is what is driving it forward, is supply and demand issue. But now let's have a look at Nationwide. Nationwide runs off of statistics of sold prices, where Zoopla and Rightmove gather a lot of their data and statistics from for sale prices, which is very different from what's being sold. As you can see, what the average house price is in comparison to what people putting their houses up for sale on average. There's a wide gap between that. So Nationwide are stating that annual house price growth increases by 14.3% from 12.6% in February. Wales remained the strongest performing region in Q1 2022, while London remains weakest. Detached properties have increased by nearly £68,000 since the onset of the pandemic, while average flat prices are up £24,000. So flats did lag behind a little bit, but they're starting to catch back up again. Again, because other prices are going up, what happens is other properties start getting unaffordable, the lower stuff naturally gets dragged up from this. Nationwide are stating in London as well, listen, I love London. I was born in London. I'm super passionate about the city, and I'm super proud of being born in London. I'm literally a stone's throw from there. If I jump in my car within 5 minutes, although I live in Essex, within 5 minutes, I'm in Greater London in 5-minute drive. Within 20 minutes, I'm in central London on the train. So I'm still right near where I'm born, still love London, but the facts are the facts. The prices got so high, the returns are so low, and it's so hard for home buyers and investors alike to be able to find their foot into that market. And the rents are struggling to keep up with demand of the house prices, because if you bought a property for £500,000, which is the average price in London, you're probably going to rent that more like for £2,000 a month, and it just don't make math. I just completed on a property for myself, which you paid £77,000 for, which you rented for £700 a month. It doesn't take an economic or mathematician to figure out which gives you the better return. But I read an interesting article from Forbes magazine this month also, and one of the things I've talked about in the past, and I'm going to say again now, now is supply and demand is what's forcing this market forward. And this is not just a supply and demand issue on the stock of availability of properties. This is also a supply and demand on the availability of lending. So this article from Forbes is really, really interesting because it states that the fact that we are still seeing such a level of activity in the market is likely because the availability and the cost of mortgages has remained consistent throughout, ensuring products remain accessible. However, unless more stringent measures are taken to tackle inflation, only time will tell whether prices growth will continue in the long run. Look, if inflation keeps on going up, the cost of living keeps on going up, the mortgage price going up, base rate goes up, this is going to have effect. I believe it's going to be a dampening effect at the moment, not a catastrophic one, but who knows for certain? Who knows what's going to go on with Russia? We don't know the outcome to this, you know. At the moment, Putin's like a, should I even say that, but I'm not sure how these algorithms have shut me down for that, but he's like a dangerous rat trapped in a corner. I heard somebody saying this the other day, I think it was Rob Moore saying, a billionaire told him this, that if you trap a rat in the corner, make sure you give it an exit, because it's dangerous if you don't give it an exit. And not calling him a rat, but he's getting a bit trapped in the corner at the moment. He's got nukes available to him, so who knows if he starts letting them off. We don't know for certain, it's only speculation, but that said, again, time in the market will beat time in the market. Getting the right style assets to weather any ups and downs in market is what's critically important. As I said, make sure you stay to the end to be able to get my opinion on how you're going to navigate that. Let me throw you in a quick little bonus one from This Is Money, and this is something I talk about all the time. This is why London is really, really, really struggling, because look, it says house prices are a record high compared to wages. How long can this pandemic boom last? So household income comparison to the household prices has a massive effect on the markets, and you're seeing this lag on London already. There's a ripple effect. Everybody talks about this ripple effect largely when London was booming and everybody's hoping to get that boom off the back of it, but nobody's talking about this ripple effect of, are these other areas going to hit this headwind and have the same effect as London as the price per earning ratio widens? I believe it is, and I believe there's a small window in these areas to be able to attain these properties. The average property in 1996 in London was £79,000. How many of you put a yay in the comments would like a time machine and go back and be able to buy one of these properties at £79,000? I would for certain. There is still properties in areas that you could pick up for this money across the UK. I don't believe these areas will grow as much as London did, but they are growing as the infrastructure is coming in, as the employment is coming in, as more people are working online, as more push from the government to level up this playing field is happening. You can see these areas increasing and increasing and increasing. Properties I was buying for 60k 2 years ago, just pre-pandemic, are now around 80k. Look, loads of people say to me, what about the last crash? What happened with the North? The last time it crashed is because it was irresponsible lending. They're lending very responsibly at the moment. There's availability of funds and lending from the banks, but not irresponsible. They want to know the inside measurement of your leg. They want to know whether you've been circumcised or what you're having for dinner. The first two questions was an exaggeration, but they ask, do you eat out? How many times do you eat out? They really lending responsibly now. The growth that we're seeing across the North is not based on money just being ready available and no real questions asked of how you can afford that. This time it's been based on affordability and infrastructure and jobs going to the area. So there's a big difference since the last one. And again, just to end this off, estate agent today agree. All of them are going towards the brakes being put on. In this article from Estate Agent Today, it states that analysts warn that the Ukraine crisis will put the brakes on the runaway housing market, despite the latest Halifax house price index showing a 10.8% annual rise. The leading housing market analyst is warning that the brakes are being applied now thanks to the Ukraine crisis. So what is going to happen? There's no signs of this right at this moment, and the signs that it showed that a little while ago has bounced back. We've had a record month, but yet all of them are predicting it's going to happen and there's going to be an effect on this. Property markets do have a delay to respond to outside economic circumstances. So the stock market, the crypto market responded to this really, really quickly. They always do. Well, the crypto's not been around long enough for us to tell through these different cycles, but the stock market always responds a lot quicker. Again, as I said, if you've not seen my video on the signs of a potential recession, jump on and watch that video, because I think you'll get a lot of understanding from that. But there is still signs that this market can still grow. And as I said, as long as the availability of money lending stays there, as long as the availability of stock of property stays low, which it's not set to increase because we're just not building enough, and the infrastructure is not even there to build enough, even if the government just said to the builders, go for it, don't worry about planning, we still couldn't achieve that. So unless the money supply really dries up, which it could, none of us know, we're not going to know which way it's going to go. But what you want to do is not think about coulds, buts, ifs and maybes. What you want to be thinking about is, how can I navigate this so if the market still goes up, I'm navigating it. If the market goes down, I'm safe. I've got that downside protection. And how you do that, and again, it's in my last video as well, I'll go into depth on it, is building an all-weather portfolio. As I said, there's a last opportunity. How many of you want to get in a time machine and go back and buy some properties in London for 79k, which are now worth on average $500,000? There's a last window of opportunity in the northeast where you can pick up properties for still under 100k, and they're going up. The rents again, so the properties I was talking about earlier on, what I was buying for 60k, the rent used to be 550. They're now 80, 90k these properties to buy, and the rents are now 6, maybe 650. So the rent's gone up with them, but not at the same pace as the price of the houses. This trend will continue as long as the infrastructure stays how it's staying. The jobs will keep on coming in, and they are. The fact that we're all going into a digital world and can do everything virtually, more and more employers are hiring people like that. But again, this plays into you being able to take advantage of this opportunity if you don't live in these areas already. Look, if you live in an area where you can still pick up properties under 100k and there's fundamentals of that area going in, then fantastic, get by and buy as many as you can now before the prices just keep on pushing up. If you don't live in an area, learn how to remote property invest. I'm the remote property investor. If you need to reach out to me to learn how to remote property invest, please reach out. Look out for my next up and coming workshop. The link for that will be on the screen right now, but also in the notes below. All the articles that I've got this information from, I put that in the notes below. I think they're worth a read for you. But please join me on my next workshop. If there's not one coming up, there will be one coming soon. So put your name down on that same list. You'll be on the waiting list and you'll be emailed when the next one turns up. We teach people how to invest remotely and live on their terms, use technology, be able to travel and live on their own terms. My why is to live on my terms. My mission is to help as many people live on their terms using education as a vehicle to be able to do that. So please evolve your ideas, live on your own terms, share, like, subscribe, and check out this next video that YouTube is suggesting for you.